Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Guy.
1 o'clock on the East Coast.
Such a shouter.
You know, it's funny. We don't have people counting us down here.
No.
Because on CNBC, we have people that say, coming back at 5. That's why
the guy goes 5 by 5.
And they start counting at 90 seconds.
Yeah, but I don't pay attention to those things, as you could probably guess. It's 1 p.m. on the East Coast. It's Wednesday, the 23rd of October. Rangers beat the Canadians last night. Every team, Dan, last night in the NHL played.
Yeah.
Rangers are obviously one of those teams.
Original 6 matchup.
It was an original 6
they
matchup
went up to
in Montreal.
Smoked the Canadians.
Elizabeth does not have a hockey team, but you've decided the Rangers are going to be your team.
Yeah, I did promise I was going to get into hockey this year. So
Good.
far, I'm failing at that.
Well,
maybe
let's
I'm going to
work
wait
on
till
it.
the
You
World
went to
Series
a
is
game
over.
last year.
Yeah,
We did.
I've been to a game or two.
Well, with
I've
Carter
probably been to
Braxton
5
Worth.
games.
I must
Didn't
been-
think he was much of a hockey fan, did you?
No, well, there was a lot of ice on the Atlantic when
think-
they came over on the Mayflower, so he's very
I
very
don't think Carter
familiar.
nor I watched.
Should we
much
get
of
into
the game.
this? Let's get into
Uh,
it. Mark,
If
interesting
it's
market
Wednesday,
day.
it's Butters.
Yep.
So we got Butters.
John
It's just
Butters.
The 3.
Senior earnings insight analyst at FactSet.
You
He
know-
was actually he was with us, like in the flesh, not in the flesh, but on the program.
IRL.
Yeah.
You know, if this had been our first show and I said that, people were like, what are you talking
What's
about?
up? Yeah,
But people,
they know Butters.
I don't even have to say it and they
Yeah.
know.
Yeah,
That's just the
hashtag-
way I look.
Hashtag Butters.
Throw the rundown up because why not? Let's take a look at what we're looking at. Actor in a leading role. This is all you, isn't it, Elizabeth? Yields. I agree with that. Consumer stocks slump. Yes, they do. FactSet's earnings insight, as I mentioned. And since it's Wednesday, we'll do a little audience Q&A because why not, Dan?
Why not? All right, Liz. Interesting markets here. It feels like we've kind of hit a little bit of a pause. Now, there's a whole host of things. Obviously, you've been detailing them on the what is it? With the SDs on the HDT.
The SDs on the
Yeah.
HTR.
You guys been talking about this. You know, it's in front of earnings season. We got off to such a great start with the banks, you know, and we had these breakouts and we saw, you know, stocks like Wells Fargo that were really kind of lagging their peers, you know, just rip and make new highs. It feels like the tone heading into the bulk of tech earnings is a little different right now, like a week and a half on, wouldn't you say, Guy? And so here we are tonight, Tesla. Big one. So what do you think the mood is heading into? We had an S&P that's up 22%. What's the mood heading into the bulk of S&P 500 earnings?
Well, I think you set it up right. We started off with a bang. We started up really positively. The banks always set the tone for earnings season, and they did a good job this time, which I think is promising, especially for the cyclical trade, which I'm sure we'll talk about on the show even more. But just looking at the market today, I mean, the NASDAQ is down 1.6 and S&P and Dow only down less than 1%. So obviously tech is getting hit harder here. There's been a nice run up, though, and I have a chart for later that we'll cover at a certain point. But there's been a nice run up, particularly in semiconductors. This has happened before where we have this give back of optimism after such a solid run. I think it's okay. I still think the mood in the market is that we're going to have a soft landing. Everything seems fine. There is a decent amount of uncertainty around rates and yields, and this continued rise in yields may be starting to pressure markets because it tightens things a little bit too much, right? You've got the Fed on one side saying that they're going to slowly loosen monetary policy, but then we've got yields rising in what's called a bear steepening environment. And it's just kind of tightening the screws. It hasn't necessarily caused a ton of direct impact yet. And stocks have not, I don't think, shown much suffering because of it. But it could just be this thing where it's like, well, what's the point when we can't stand it anymore?
Yeah, I think that's exactly right. To your earlier point about yields, actor in a supporting role or leading role.
Leading.
Because they're the story, right?
That is the story.
It should be the story. It doesn't necessarily send a clear signal, though. And that's what my piece today was about.
Today, like a little mini taper tantrum. You see what I'm doing here? Just think about that. Go back to
it's funny. That's another of all the things that I'll never
Santa
say.
Claus rally,
Goldilocks.
Taper, that's another.
Yeah,
one.
but all right.
For
So
tantrum.
you remember what happened in 2013? You know, so the Fed started indicating they're going to pull back. Isn't it amazing that 2013 they were going to start pulling back their monetary support, which was in the wake of the financial
How long
crisis?
that lasts?
It took a long time, but you remember we had that sell-off. Today is interesting because you were tracking some of the data about how long it was before we had a 2% down day in the S&P. That was back in August. It's kind of a big move, Guy, for a one-day move in the S&P. At least is what we were
so far.
And by the way, you've been highlighting the facts a 20 VIX has been saying something.
It's been sticking around. The VIX has been hanging around, and I still think there's a leg higher in the VIX. And, I'm with Elizabeth. I agree with you, by the way. I think yields are the leading role right now. More people should be paying attention. And I don't know if it's ever happened before. I mean, I'm sure Ken Show, whoever works at CNBC, will be able to ascertain. But, you think about the move in yields since the day the Fed announced a 50 basis point cut. It's got to be unprecedented. And, it's interesting to listen to people, intelligent people. And, I'm not suggesting I'm right, but, there's a thought that if they were to cut again, maybe that would assuage some of the concerns, and I think it'll make it worse, quite frankly. I think what you're going to see is 10-year yields continue to rise regardless. And I think the 2-year yield, and Elizabeth's talked about this, will just stay stubborn, if not go lower. So you will see a steepening of the yield curve. But as you have said countless times for the last couple of years, it's not the inversion that gets you, it's the re-steepening, and it's happening before our eyes.
Yeah.
So Liz, let me just, before we get to your note, and it's a lot of great stuff, and it's going to focus on this. Doug Cash just hit us, and I think this is a really great point, and I want to get your take on this as it relates to the equity market and valuation. So he's saying first level thinking, earnings are up by stocks. Okay. So it really matters. How much are they up relative to expectations? How much are they up sequentially, right? How much might they be up in the future? Second level thinking, earnings are up, and it's been discounted in higher prices. Now that's where Guy and I have been on some of these mega trends, secular shifts. You have this sort of outperformance, and it's very concentrated. Well, it's obviously pulling forward a lot of enthusiasm about whatever that shift is. So how are you thinking about that right here, right now? And a lot of folks, you're going to start working on your 2025 outlook, you know what I mean, at some point. So curious to the way you think, is once we get by this election, I think there'll be a lot more clarity, and then people are really going to focus on 2025.
Well, so one of the things, and I know Mr. Brian Belsky at least agrees with me on this, even though he's so much more bullish than I have been for the last year or two. One of the things that I think is a theme right now in markets and in earnings is normalization. So you've had some really, really strong quarters of earnings, double-digit growth. The expectation this quarter is somewhere between 4 and 5% earnings growth, which is much lower than what we've been used to. If it's already in stock prices, I think Doug is probably right. It's already in there. We've pulled it forward. We've got the optimism in the stock price already. Now we have to go through this normalization phase where earnings growth comes back down to a relatively historically normal level. 4% is actually below a historically normal level. So that would be technically disappointing for where prices are. But prices probably also have to go through a normalization process, and multiples have to go through a normalization process, and inflation has had to go through that, and the Fed funds rate has to go through that. Everything in the economy has to go through it, and those transitions are not usually smooth. So I think what we're seeing right now, especially reflected in yields and reflected in the VIX, is that we know we're transitioning into an environment that's different from the one that we've been in for the last 2 years. But what does that mean for the next step? Is that good for stocks in the next step? If we go back to normal, the expectation would be that the equity returns we get are somewhere between, let's say, 5 and 10% annually.
I spend a lot of time reading the sports section. Dan spends a lot of time finding these new newsletters and podcasts, and you stumbled upon one called The Daily Shot. And this is actually interesting because this speaks, Elizabeth, to some of the things you've been talking about. U.S. market-based inflation expectations have risen to the highest level since June. These are what we call the U.S. 10-year break-even rates. And that suggests, it's fascinating what it suggests, that maybe the inflation picture is not as clear, is not as fixed, is not as controlled as I think participants might have thought prior.
Yeah, well, so here's the other interesting thing about what's happened with yields and this particular dynamic. So back in 2022, we knew inflation was a problem. It obviously was something that needed to be combated by Fed policy, and that's when we started to do that. The market sold off in response. So we had yields rising during 2022 as well, but it was bad for equity prices because it was an inflationary rise in yields. This rise in yields right now has not been interpreted as an inflationary rise in yields. It's been interpreted as a solid economic growth story. It's been interpreted as we can withstand a rise in yields. We can withstand inflation even slightly hotter than it is now because the economy is so strong. So in response, stocks continue to rise. And that may be the right way to look at this. I think that there are still a decent amount of risks on the other side of it. What if we start to get disappointing economic data? Because ever since September 18th, we've gotten some really good data. What if we start to get disappointing data? Do we have to give this whole trade back? The answer to that might be yes, in which case we have more volatility and more whiplash in yields.
What's interesting about this is if you're playing it on the bond side of things, you don't really have to have a view on the reasons why necessarily. See, yields are either going up because the economy's great or yields are going up for something else, right? Because maybe underlying inflation is a problem or all these issuance we have to do, debt's too high, all that stuff. But if you have the yield story right in terms of direction, in terms of equities, it makes a big difference. Now, Dan, I'll ask you this.
Sure.
Paul Tudor Jones on CNBC yesterday. Short bonds, long gold, long Bitcoin, long NASDAQ stocks to a point. And Stan Druckenmiller, who we've talked about now for the last couple of weeks, is now 20% of his portfolio is short bonds. So they're betting that yields will go higher. Now, to Elizabeth's point, they're going higher because the economy's strong, which should be supportive of stocks or some other reason. So thoughts on that?
So doesn't this tie into the Goldman Sachs call yesterday by David Kostin? And you were talking about, or maybe this was earlier in the week, but
it was actually last
came over
Friday,
the weekend.
Yeah, so they're saying the S&P 500 is expected to post annualized a nominal total return of just 3% over the next 10 years. And that's pretty fascinating, right? Compared with the 13% in the last decade. They also see a roughly 72% chance that the benchmark index will trail treasury bonds and a 33% likelihood that lag inflation. Okay, so that's kind of interesting, right? Like there's been a handful of people on both sides of this. I guess the takeaway here is that, bond returns are going to outpace that of equities. And again, this is a really hard game. This is one of the reasons why you're not into the price targety sort of thing or whatever. So what did you take away from that? And especially in relation to some of these huge whales who've been right almost about everything over the last 40 years in the markets?
I mean, the first thing I took away from it was I was surprised it was coming from Goldman Sachs because it was a pretty bearish outlook on equities and a bullish outlook on bonds. And basically what he's saying is that this is a good entry point in bonds, or at least in treasuries, because the yields are perhaps a little bit higher than they should be. I would agree with that actually for a long-term period. Perhaps Paul Tudor Jones and Druckenmiller are thinking of it over a more trading period, right? They're shorting it. Usually you short things over a trading period, not necessarily a long-term holding period. But if we're entering an environment where bonds are going to see this slow grind lower in yields, this probably is a good entry point. And there are certain limits on it. When the 10-year treasury gets up to 4.2-ish, people get nervous, that sort of thing. I think this probably is a good spot to do that in treasuries. Now, the flaw in some of their analysis, and they pointed out in their own report, the flaw in it is that the suggestion of only 3% equity returns also hinges on the idea that market concentration is a big problem. And I don't think that we're sold yet that market concentration is going to cause that much of a problem or that it has to stop. I think that's really the question. Does it have to end? At some point, yes, probably. And over long-term periods, we know it will end. Back in the, 70s, 80s, 90s, financials were a big portion of the market. Now they're not. So things shift over time. But are they going to shift in the next 12 months? Maybe not. And maybe tech can continue to drive things forward. So that's where that report has to become more bullish if market concentration is actually okay.
We had Katie Stockton on Fast Money last night, and she's a technician, as you know. I think she does a great job. I admire her work. And pull up this next chart about yields. And one of her thoughts was this is a logical place for yields to stop on the upside. In other words, for TLT to slow down on the downside. And if you look at yields, we're right up against that 150-day moving average. Yes, we're through it, but her point was, okay, you've had this big run in yields. Let's take a trading pause here. Now, what's interesting, Dan, again, just my opinion, if we were to see the market sell off like we're seeing today, history suggests on a market sell-off, there will be a flight to perceived quality in the form of bonds. So as a trading call, by the way, I want to be crystal clear. I still think yields are going higher, but on a trading call, this might be a logical place to get long TLT or to think yields are going to slow down.
Yeah, and I just want to mention one thing about Tudor Jones and Druckenmiller. I doubt they're making a trading call. You know what I mean? If they do it in the sort of size that Guy just spoke to and what you read about, I mean, this has got to be a position that you're taking an intermediate to longer term view. And what could that mean? It could be a year. These guys only come out once a quarter, go on CNBC. So I think they really care about their credibility on that front. Not that they're investors or, the sort of folks that are generally watching CNBC. So I guess what I'd say to that, I think from a trading perspective, maybe just like these things overshoot to the upside, they have the likelihood to do so to the downside. I think what we're seeing here today is a combination of uncertainty as it relates to Fed policy, uncertainty about the economy, uncertainty about the election. You know what I mean? So could we have a 5% drawdown? If Amanda wants to throw up that S&P chart again, it's like these new highs have been unabated. It seems like since the lows, in August, once we got back to those prior highs, and the September move right up until last week. So, that's kind of my only 2 cents. Guy, you tell me that 150 day that lines up pretty much with the September lows, but that would be a 7.5% decline from the highs. I don't think that's happening.
Well, we talked about this yesterday on Market Call. You can draw a trend line from the November low, that next low we saw in August, and the third point will come in right around that 150-day moving average. The shorter uptrend that we're in from the August low, we're seemingly right at that support level now. So I'm not. Look, again, it's been very difficult to try to figure out what the S&P is going to do, but we are set up in such a way, given what's going on into an election geopolitically around the globe, some of these macro headwinds we're talking about, the move in bond yields, the move in precious metals. I could rattle off another 4 or 5. It would suggest at some point that the S&P is going to take a pause. Now, I'm going to say a name to you, Elizabeth.
Okay.
Now, I hope you know who this is.
Okay.
You ready?
I'm nervous.
Edison Lighthouse.
No.
No.
Mm-mm.
I pull up Elizabeth's slides. Yields go where the macro winds blow. Now, I hear that, and that's hauntingly familiar to my love grows where my rosemary goes, a song by Edison Lighthouse. You're not familiar with that song?
No, I'm not. No.
I guarantee Doug Cass will text me in 30 seconds and say, you're absolutely right. Because when I see that, that's what I think about it. We'll put it in the show notes, but speak to this, please.
Okay, so this basically shows you in a picture what we've been covering for the show so far. So this is the 2-year and the 10-year yield, the 2-year in magenta, the 10-year in blue, and then the dotted line is the 2s, 10s spread. And then we've shaded the periods where we had positive economic surprises. So remember, inflation was coming in hotter than expected for the first part of the year. And then in the middle part of the year, we had some negative economic surprises. We were anticipating the Fed starting to cut rates, and then it got confirmed that they were going to cut rates. So what you're seeing here, this is whiplash. This is bond whiplash in 2024. So we see yields rise very steadily through about April, the end of April, and then fall very steadily until early October. And then this is the rise that we've seen since then. So we're moving back and forth. So this is number one, to point out what has been driving this. This is all about the economy this year, not necessarily about inflation. So this is either positive economic data or negative economic data. The interesting part too, once the Fed cut rates, that's when that rise in yields really began, and it continued as we got more positive economic data thereafter. If we go to the next chart, why do we care about this? This is what's called a bear steepener. So then how do things perform in a bear steepening environment? So what's happening right now is in the light blue bars. Okay, this is since that Fed cut. This is since September 17th. So we're including the day of the cut. So the light blue bars, we see tech, communications, financials, industrials, energy leading the way. The dark blue bars are how things usually work out. A little bit hard to see that trend exactly on this chart, but it is actually working out how things normally work out in a bear steepener, which is that cyclicals do well, defensives do not, and rate sensitive things do not. So you're seeing real estate, healthcare, staples on the other end of that spectrum. So the pattern is playing out as we would expect it to, because the economy is doing well, cyclicals are doing well. You might be asking, well, then how can tech be leading by such a wide margin? Well, what's leading in tech? Semiconductors. That's the most cyclical component in tech. So that trend still plays out even in the tech space. And then last chart, we mentioned this, or I think, Guy, you just sort of alluded to something about this. Here's the drawback of a bear steepening environment. So we talk about bear steepeners. It's bearish for the bond market. It is actually bullish for the equity market generally. Where it's not good is in the lending space. So you've got mortgage rates still stuck above 7%. What I want people to pay attention to on this chart. So we talk a lot about the 10-year treasury yield and the correlation between that and mortgage rates. Usually there's about a 300 basis point spread between the 10-year yield and the mortgage rate. That is the case right now. But look at that pink section. That's what we're calling the duration uncertainty spread. So the uncertainty that we have around what the Fed is going to do, the uncertainty and the volatility that we have around treasury yields, that portion is much wider than it's ever been before. So basically that portion, the uncertainty that we have around rates and around Fed moves and the volatility we've seen in treasuries is adding and keeping mortgage rates high where they are, higher than they would be if we were in a much calmer environment. So this keeps the housing market frozen. It keeps home prices high. We had existing home sales today come in at a 14-year low. So we're still stuck in that same problem.
It's fascinating to me, the level of uncertainty, and it's been going on, by the way, for quite some time. The market trying to sort of ascertain what's going to go on here. But, you know, your point about that 300 basis point spread, absolutely, that has been historically true. My concern, though, is, and this could happen, now you could see that sort of blow out in terms of mortgage rates, where mortgage rates just start to trend higher on the back of nothing. And then the housing market's really in a bit of a pickle. Now, the good thing about the housing market, I think, is the fact, and we've talked about this many times, so many people have been locked in. They're not going anywhere. So there's no real concern. The concern, I think, should be, Dan, and again, it's been somewhat unfounded, but I think it's relevant. If the unemployment rate, which I think will start ticking higher, especially post-election, starts moving in a meaningful way, and all indications are it will, that's what's going to unlock some of the inventory. And that's what's going to sort of, I think, create a really weird environment for the housing market.
Yeah, and if you think about, you know, mortgage rates went from, you know, north of 7% to north of or south of 6.5%, and now they're back. I mean, that just speaks to the sort of uncertainty that we've seen. And if you look at the certainty that equity investors have had as it relates to home builders and kind of some related names since that rate cut back in mid-September, that's the sort of thing that causes some folks to kind of be off sides a little bit. I just want to make one other point. Guy, our main man Doug sent us two things, Guy. He was Johnny on the spot.
I knew
right,
he would know.
Yeah.
I'm not surprised you don't. It's funny, Elizabeth, and I'm sorry, Amanda. We have Guy's first playlist on Spotify.
It's basically his library.
It's almost 900 songs now.
Okay.
It is extraordinarily. It's a wide-ranging, all-encompassing, I think, the best playlist that's out there.
Okay.
Dan last night on the set of Fast Money was all just, oh my God, this is
his
an awful
library.
song, blah, blah,
it's
blah.
not a playlist.
Right.
But what I'll tell you is
songs, and they're not curated.
Love Grows Where My Rosemary Goes by Edison Lighthouse is absolutely on my playlist. And we'll play it for you after the show.
I'll listen to it after.
So here's the other email. This other text, and maybe Amanda can throw this up here. So this is Goldman Sachs data, market cap of the largest stocks relative to the 75th percentile stock. This is the left axis over there, and you see what's going on. So Doug is making the case for, you know, just the stretch valuation here, Liz. So when you see that sort of data, your data on the yield front was going back a long time too. You know, these things can blow out longer than expected. If you look at 2000, which is interesting that you could have made the same argument back then. This would be, you know, just what, a few, I don't know, you know, years ago or that sort of thing. And here we are now, you know, in COVID, we're just blown out. We just absolutely blown out.
Yeah. So Doug, correct me if I'm wrong, but I think also the reason you sent this chart is what I was saying before about Goldman's report. The flaw in their report could be if market concentration isn't a problem. So here we are looking at why they think market concentration is a problem. So the line that we're seeing all the way on the right-hand side, obviously large cap stocks dominating the market right now and causing this concentration problem. As you can see, what happens after we have peaks like that, things fall pretty precipitously. This is much like the unemployment rate, but in reverse, right? Once you have the low, you see that escape velocity. So what would it be called on the downside? Escape?
I don't know. That's a good question. I'm not sure.
We'll have to coin a new term. But I think that's the other point that Doug is trying to make with this chart. This is exactly what Goldman's concern is. Usually you see this come down. Obviously, if we've got a really high amount of market concentration and it comes down on the other side, so goes the rest of the market.
When I was younger, I was trying to get into my parents wanted me to go to Catholic school for like pre-K or something. It's Sister Colleen, I believe. You remember these things?
Well, I went to Catholic school until at the end of third.
And I did not. And the reason why I was not allowed in, because I couldn't connect the dots. That's 4 years old. It's a problem.
The game
stays with me to this day, obviously. But you know who's very good at connecting the dots, Elizabeth? Bit of a rhetorical question. Dan Nathan. Now, I mentioned that because Verizon made some comments the other day in terms of just the demand they're seeing. And then if you start to connect the dots, well, who buys what at Verizon? You're buying these things. What do they call these things?
The iPhones,
the Apple
smartphones.
phones.
Yeah.
Let's look at this next slide.
All right, so this is one I think, again, we've been talking about this guy, the whole notion, and back in June, when you see that right about in the middle of the chart, that kind of 10% straight up move. This was a $3 trillion market cap stock then. This was the 2 days after the Worldwide Developers Conference. Most of the analysts came away from that conference, and they had previewed this Apple Intelligence, which was going to be their generative AI, product on top of the iPhone 16 and Pro. That this was going to launch a huge upgrade cycle. They were saying that there's 300 to 400 million iPhones out there that have not been upgraded in 3 to 4 years. So the stock really, other than that August, kind of sell off, which most mega cap stocks had, it's been a monster, right? Since that initial move. So here's an analyst. This is a guy from TF International Securities. His name is Ming Chi Ku, and
Nice.
he is to be honest with you, he's a very well followed analyst on Apple builds. And so if he's saying this is down by 10 million, that's not a huge number. I think the expectations are in the calendar year that next year they're going to do 220 million. Okay. But it speaks to maybe the lack of interest in this device for the reasons that they've laid out that people should be upgrading. So when I see this guy, it's shocking that the stock is only down 2.5% or so. And we're going to know, I mean, they're going to report earnings in about a week and a half, and their guidance is going to be really important. So, some of this data is really hard to trade off of, but thoughts here, Guy, because this is going to be a big one, in my opinion.
I absolutely have thoughts. Here are a couple of them. You just made the point that you're surprised it's not lower. Oddly enough, a down market of this magnitude actually works to Apple's favor, as not only you see a flight to quality and other things. Historically, what we've seen is this flight to quality in these big cap technology stocks. So I think, but for the fact that the market is getting throttled, Apple probably be down more. Just my opinion. 10 million might not be a big number in the scope of things, but it's a huge number when you hear guys like Gene Munster talk about the upgrade cycle of all time, right? So this obviously is not the upgrade cycle of all time. And I think that move from 193 to 237 or so was predicated on exactly that. And then you look at the chart. I mean, we just traded up to the levels that we saw in July after the June 10th event, traded down, as you mentioned, August 5th, got it all back. Here we are, this short-term double top. Technically, not so good. The moving average comes in around 205, 206. I think that's reasonable. And, oh, by the way, there's still this mega gap on the chart, much lower, that I think the market's going to sniff out at some point.
If we get there, this market's going to need a lot of problems. Low. Hey, Liz, just to cue on something that Guy just said, do you know what a but for is?
Don't
It's for sitting.
Don't do it.
Sitting.
Don't do it.
That's what. Hold on. This is anecdotal at best, useless at worst. I have been like clockwork upgrading my iPhones every 2 years.
Yeah.
And I'm due this year. I chose not to because I'm not convinced.
No,
and the one I have works fine.
I think that anecdotal stuff is important.
This is the first time that I have not done it like clockwork. I usually wait until they release it. I pre-order it, whatever. And this year I was like, I'm not paying $900 for the same experience.
You go, girl.
One thing that's really interesting, Guy, is that the ASPs, the average selling prices for iPhones, they're not going up, which to me, it speaks to maybe something that you just said, is that, think about the laptop that you have in front of you. It might cost $1,100. People don't upgrade those every 2 years. You know what I mean? They upgrade those every 4 years. You upgrade them until they basically die. You mentioned Gene Munster. I love Gene. He's a great analyst. He's a long-term thinker also. I had Dan Ives on the pod. It's actually in the podcast store today. We recorded it yesterday afternoon, and we actually discussed a lot of this stuff. And I really like Dan. He's not afraid to make calls. Some folks will just call him a perma-bill. And I know he comes on halftime a lot. He's an eccentric guy, but we had a really good conversation on this. So check it out in the On the Tape podcast feed, Guy.
Yesterday, you and I on Market Call talked about McDonald's, and we talked about how, it had that huge move lower on the back of the CFO talking about their consumer being strapped, and that scared me, and the stock acted in kind. They got back on their footing. They introduced these menus. People got excited. Stock was making all-time highs. Obviously, during our show, before our show, but after the market closed, you had the news about McDonald's came out. Now, this is what I said last night with limited information, and more information is coming now. It's one of those things where you got to let this play out. And again, I don't know how it's going to play out, but we used obviously Chipotle Mexican Grill as sort of the example to use. And you go back to 2015, it was October, and then again in December, and the stock basically got sold off of about 60%. I'm not saying that's going to happen here with McDonald's. Difference is there's a fatality here. There were no fatalities with CMG. McDonald's has seemingly identified the problem very quickly. We'll see. However, you see how quickly things go pear-shaped. Again, it's not necessarily I'm not looking to trade McDonald's here, but you look at this and you see how,
Are you surprised though? Only 5.5%?
I'm surprised it's not down more. And I said that last night. I thought we could trade down to sort of that 250-ish level. If a man can put up a longer-term chart, you'll see, a couple different times we've gotten down there. It's been support and resistance. That makes a lot of sense to me. But, here we are hanging in there, I think, pretty well.
Yeah, so this is one of the stories, and we say this all the time. There's thousands of stocks out there. Have a ball, trade them all. I mean, when you have this sort of uncertainty and a very, stay away. Who knows, how long this will take, if there's any other issues, does it spread? That was the point, guy, in 2015 with the Chipotle. They could never put their finger on exactly what the problem is. And the longer it went on, the behavior of consumers just changes. You just say, and now there's lots of other options. So again, I think the trade down point, maybe you can opine on that, Liz, a little bit, because if you go back to that 1 year, I mean, this stock was trading horribly in an environment where a lot of staples were trading pretty well. This is in consumer discretionary, and to Guy's point about the value meals and all this sort of stuff, it trades like a staple. It should trade like a staple, not a discretionary.
Yeah, but it was, I think, getting too expensive to be looked at that way. At least expensive in the sense of as a consumer to go into the store and buy something. I mean, for example, now I didn't get E. coli, but I did just eat at McDonald's recently. I got a cheeseburger and a small fry, and it was almost $6. I remember when cheeseburgers were 79 cents.
Yeah.
And hamburgers were 69 cents.
Where the hell did you go? Like Beverly Hills? I mean, where are you eating at McDonald's?
It was on the way back from out east, but that's it. I didn't even get a drink. It was a cheeseburger and a small fry, and it was $5 something.
I believe her.
It was.
Why would she lie?
I'm going to they might be.
Well, now I don't want to do it again, but in any event.
Well, that's sort of the point I was making last night. Regardless of what it's been identified as, whether it was a quarter pounder, it doesn't matter. You're not necessarily rushing back to McDonald's, I don't think, until there's some sort of all clear sign, which, you talk about transitory. That's almost a definition of. But the question is, how much damage can be done to the stock before they sort of have their arms around it? So we've mentioned that just to mention it. By the way, you're right to point out the fact that the stock was expensive on the way up. People look past that. Now it's expensive, and they obviously have issues. Starbucks, Dan, doesn't make any sense to me.
Yeah.
Because listen, I think we all anticipated they would do something like this with Brian Nichols' first call. But I thought the stock, given the run that it had on the back of that announcement, I thought it would give most of it back, and it's hanging in there like a champ.
Yeah, but there's a huge gap to be filled at this point, right? And so if you pull the guidance, you're not going to put the guidance back out until you make some real changes in the business, right? And so the new CEO is going to have some time to do that. But I go back to the McDonald's situation, and maybe Amanda can pull up a Chipotle or a DPZ, which is Domino's. There's a lot of problems in these spaces. Before Starbucks made that management change, the stock was trading a lot like them. So you got to make you got to think about this a little bit. I mean, that one was trading very poorly just a few months ago. Look at the gap that we have there a few months ago. I mean, some of these names are kind of stuck in the mud. And so, Liz, I guess the question, and we've been talking about these two different consumers here in the U.S., a higher end consumer that's kind of hanging in there, and a lower end one for the balance of, I don't know, last year or so has been having a tough time. Maybe Amanda can pull up Walmart, and Guy has been saying this, I think, for 6 months, all roads lead to Walmart. All roads lead to Walmart. You'd think that they just, got into the Gen AI game. So thoughts on the consumer here and in general?
Well, there's still problems in luxury spending. Yeah. First of all, a lot of the luxury companies have reported disappointing results. So obviously, even the high-end consumer is pulling back a little bit, but there is still quite a big bifurcation between the haves and the have-nots in consumer land. And I think McDonald's is actually a good indication of that when it was too expensive, because that's targeting obviously a lower income consumer. And then we all know what's happened with Dollar Tree, Dollar General, still targeting a lower end consumer. Now, I think what's happened in companies like Walmart is effectively eating the lunch of those other ones that are suffering. So I think the consumer at this stage, and I've talked about this before as far as it relates to inflation, because now we know that inflation maybe had stopped coming down. as much. And there's still some question about the labor market. Everybody feels okay as things are right now, but there's still a question about it. And we're not totally sure how this is going to shake out. I think consumers have hit a bit of a pause button on their spending. They were spending what I'll refer to as willy-nilly for a long time, whether on credit or with cash, it doesn't really matter. People were just spending. That has slowed down, and they've changed their taste, or at least changed their behavior on what they're spending on and how much they're spending. So I think the consumer has pulled back a bit. The reason that relates to inflation is that if we do have a renewed issue in inflation, I don't think it's going to be because the consumer suddenly starts spending a lot again.
Agreed.
Regardless of whether the Fed continues to lower rates. I don't think that's going to do it. I think it has to be coming from somewhere else, whether it's a supply chain issue, a commodity price issue, whatever it may be. But I don't think the consumer is going to be the driver.
I agree with that. I 100%, by the way. And that's sort of what Paul Tudor Jones was saying in terms of he thinks there's a commodity.
You were going to go with John Paul Jones. You honestly were so teed up to do that.
Because I always have Zeppelin in my brain.
We know.
Obviously.
Elizabeth actually said this to me recently when we were dissecting the band Led Zeppelin. She goes, you know what's amazing about Zeppelin? Remember you said this to me?
No, I do not.
She said, of the 4 members of the band, you can make a compelling argument that John Bonham is the most accomplished musician.
She did say that.
And then she said, but John Paul Jones was brilliant, not only his bass playing, but his keyboards. And he really was the glue of that band. Then a Jimmy Page, and then Robert Plant. It was a fascinating synopsis by you.
I'm really proud of myself. It was
great
out-of-body
job.
experience.
Before we get to Butters, the senior earnings insight analyst at FactSet, we have to go to Tesla. We can't bury the lead. They report today. 7% implied move, 7% to the downside, probably gets us to the 150-day moving average, which I think is 203. 7% to the upside fills that gap that we have. So you're sort of in no man's land here, Dan. I know you're not expecting a lot. I am not expecting a lot either. I think it comes down to margins. I've been saying that now for the last year and a half or so. When they promised us that you had seen trough margins, that was not the case. Quick thoughts here.
Yeah, I'm with you on the margins. You and I were talking about it quickly on Fast Money last night. When you look at the GM quarter that they just reported and you look at their gross margins, which are basically in line with that of Tesla's, expected to be somewhere around 17.5%. That's down from 25% gross margin just 2 years ago. And you look at automotive gross margins. This is the key. I mean, they're in line with GM. And you say to yourself, why is this stock trading with a 700 billion, nearly that market cap versus, GM that's 1/10? Well, you have to believe that Tesla is not just an auto company. And they just had this robo-taxi event. It was very disappointing when you think about what people's expectations were for that. This Optimus robot, a bunch of stuff as it relates to Gen AI. So, I just don't know how it makes any sense. You have GM with a $58 billion market cap versus a $658 billion market cap.
Yeah, listen, we'll see how it's good. We will lead Fast Money with this, regardless of anything else that happens.
What is Liz scrolling? I have the opportunity to look over my shoulder a little bit.
Recreate my McDonald's.
I already did it.
And how much was it?
189 versus $329 or something like that. So let's just do the math. It's $5. It's not 6.5.
Well, with tax, it was 5 something.
Give the girl a break. I believe
6.5.
Elizabeth.
I said almost 6.
Did you say almost 6?
Yes, it was
Seems
5
like
something.
a lot.
It does seem like
a
lot.
But
if
I went and looked at,
but
hold on a second. I just went and looked at their $5 value meal. You get a double cheeseburger, fries, and a Coke for $5.
I didn't want all
that's what I know, but that's why I was thinking, how could the pricing be like that?
Right.
You know what I mean?
Yeah.
For 2 items.
The jamming you into a Happy Meal.
Well, that's why. I mean, listen, those $5 meals did really well, and it obviously speaks to what you're saying, is that it became a little more discretionary when you're getting towards a $10 price.
By the way, nobody gets small. The small fries come in a bag. The bag is flimsy as hell.
I don't want more than that.
Yeah, but you have
large
to
fries.
if you're making that, you have to reach into the fryer and you have to put the fries in the thing.
No,
they don't. They have a scooper.
That makes sense. That a person of normal intelligence would say that. I'll just leave it at that. You can Google that. And
let's
see who is thinking about.
I know what you're talking about.
Go ahead. You do this better than I do. What's next?
All right. If it's Wednesday, guy, we get a preview of John Butters. He is the senior earnings insight analyst, a report that drops in your email box every Friday morning. You can get it there by going to factset.com/insight/ subscribe. This one is interesting. So this week, guys, so we're talking about margins. Okay. So if you just want to kind of look at this a little bit and you want to kind of poke through what John, and by the way, interesting timing for this.
Yep.
As we think about earnings, we're looking at Tesla and we spent some time talking about their margins. Let's talk about this, the net profit margin for the S&P 500 Q3 19 through Q3 2024. That would be this year. The blended, okay, this includes actual and estimates net profit margin for the S&P 500 for Q3 2024, 12%. This is above the 5-year average of 11.5%. And the market's second straight quarter, the index is reporting a net profit margin of 12%. However, it's below the year ago net profit of 12. All right, listen.
All in line.
Yeah, all in line. So what is it telling you here? 5 years on, it's in line.
So not to play politics at all, but this is John's work. This is work with actual numbers.
Yep.
So for all the people out there that's saying companies are gouging and they're the source of inflation, that's the reason why people are paying higher prices, this clearly shows that's not the case. Margins are exactly what they've been for the last 10 years. I think we agree on that because you're looking right at it.
Yeah.
One would think that margins actually you would think with all the productivity gains we've made, margins would be a little bit better. But okay. The question, though, is I think if we're starting to turn down, what's going to happen to margins? And the first thing that happens as we start to go the other way, Elizabeth, is what? The first sign is you start to lay people off. And I think I don't think this suggests that to me, but in the want to keep margins stable in an environment where they're going to be, I think, strapped to do so, I think the unemployment rate is going to be the variable that moves up. Thoughts on that?
Yeah, well, and it's usually the last thing that moves because CEOs do everything they can to avoid laying people off, especially after we're coming out of a labor market that was so tight where we couldn't replace workers if we got rid of them. So I think most companies are hesitant to let go of workers. But if we get to a point where margins are compressed or it happens very quickly and they don't have anywhere else to cut, I think companies have done a decent job of cutting already and trying to manage their expenses aside from engaging in layoffs. Then that's where you see that start to happen. Now, the argument right now against that would be, well, look at initial jobless claims, look at continuing jobless claims, nothing in there showing anything concerning. And that is true. And there are some things that are going to happen in the next few weeks because of the hurricanes and blah, blah, blah. So we're going to explain any movement away anyway. It doesn't matter. Those are the places that you would start to see it first, and we haven't seen it. One thing I would leave everybody with, though, is there are a lot of industries, if you look at California's tech industry, for example, where claiming unemployment doesn't get you much of a benefit, right? If you're you've been laid off or whatever, you've got maybe stock benefits, maybe you've got some kind of severance going on. The trouble that you have to go through to claim unemployment in order to get your whatever it is, $400 a week, people just aren't doing it. So I don't even think it's really representative of the unemployment rate and how many people actually are unemployed. I think there are people that are just choosing not to claim it.
Yeah. And so lastly, let's just look at the sectors that John's highlighting here. So this is only 2 sectors are reporting a year-over-year increase in net profit margins. And I bet you can't guess what they are. Okay. It's technology and communication services. 7 sectors are reporting a year-over-year decrease in net profit margins led by energy. And that goes to it speaks to exactly what you're saying about price gouging.
I think so.
Look who has the pricing power. It's technology and communication services. What's a big part of that? It's this secular shift for Gen AI. So if NVIDIA and a bunch of these chip companies are able to charge more, so that's an increase in profit margins. And then obviously what's going on with some of the hyperscalers and the like. And this also speaks to the concentration that Liz and Doug were just speaking to in the stock market. So listen, John Butters, we appreciate your work. As always, you can go find it. You can, you know where you can find it right there. Yeah, let's throw it up there. That slide.
I like when Butters comes on.
That was great last week. We're going to have him hopefully a bit more. Factset.com/insight/subscribe. By the way, guy, Liz, we just previewed her note that drops every Thursday.
I like the tic-tac-toe board.
Yeah, let's throw that up there because if you want this in your inbox, you can do that too. You can go to the SoFi.com/on/on-.
We are also revamping. We're revamping the
because
email.
of us.
No.
It has to
No.
be because of us.
I
He's doing
think
a
you're the
revamp.
only one that struggles with this. To be
Guy
perfectly
struggles with
honest.
it.
Oh, no, sorry. It's a tic-tac-toe board.
No,
No.
the way
Oh,
to
the
get there.
backslash and
Yeah,
stuff.
all that dashes
Dan
and
just
slashes.
struggles with slashes and
I,
dashes.
we have a couple questions. We're
Let's
running
do it.
late.
Let's do it.
Wavy McFly.
Oh,
Wavy's with us all the
a
time.
frequent question.
Love
You know
Wavy.
from the wave.
Yeah.
Yeah.
At what yield does Guy or Elizabeth or Dan think that the 10-year yield has to hit to force the Fed to reintroduce QE, God bless, and embark on yield curve control? YCC, we call that.
Mhm.
Wow.
So
If
at what
you're-
point do we become Japan?
Yeah. I hope that doesn't happen. I mean, think about what's. By the way, thank you for saying that. Throw up a Japanese yen chart, man, if you can, real quick, because as I put on the Twitter earlier, the Japan is the fourth largest economy in the world, just slightly below Germany. So it's effectively tied for third. Their currency is moving like a developing emerging market currency. I mean, dollar yen got up to about 153 and change. I mean, look at these moves are extraordinary. And by the way, the yen is weakening while their bond market deteriorates. Yields are going higher. I mean, something is amiss there without question. So we don't want to be Japan. But to answer Wavy's question, I think if we get close to 5% in the 10-year, which is not out of the realm of possibility, I think the alarm bells are going to go off in a meaningful way, Elizabeth.
Yeah, I think so too, especially if that's commensurate with a move in inflation expectations. So the Fed will tell you until their face turns blue, they don't watch necessarily the yield moves, but what they do watch are inflation expectations because they care about inflation becoming entrenched in the economy. And the way that they define entrenched in the economy is if expectations continue to rise and stay elevated. They do not want that to happen. I would find it hard to believe that yields would go up to 5 without inflation expectations rising. So both of those things probably happen, and then the Fed gets spooked.
From Chris E. Guys, can I get, and gals, can I get your opinions on institutional favorite Elevance Health? It used to be Anthem, ELV. These stocks, they're going to talk about in this question PE and how cheap it is. It's got nothing to do with that. Pull up a chart and you'll see. I mean, all of these stocks, and UNH is the only sort of outlier. They have been awful. And if you do a longer term chart, you'll see we're at a pretty critical level here in terms of support. So forget about valuation. It's all about MLRs, Dan. That's medical loss ratios, which have been trending the wrong way for this group. You'll see this level we're at is basically the same low we made. I want to stay over the summer-ish. So pretty important level. We've obviously gone flying through the 150-day moving average. I mean, to me, this is a no touch, Dan.
Yeah, this is not a space I know Jack about, so I'm just going to pass.
Who's Jack?
I just, you know me, Guy. When we're doing the fast money, I'll go for like 2 segments, and I just look at Mel and I give her like,
and then I'll turn to you if you say nothing in the block. Either I will do it or Tim will do it, and we'll say that was the best block you've ever had. That's very funny.
Silence is powerful sometimes.
Yes, less is more. If you're not subscribing to the Risk Reversal YouTube page, I know you have.
Of course.
We have just gone over, I believe, 92,000. As I've mentioned a number of times, we are trying to get to 100,000 before the end of the year. It is now October 23rd, as I started the show with. So not a lot of time left. Apparently, half the folks that watch this show are not subscribed. Why wouldn't you subscribe, Dan? What is all?
Look
all
at how
you
much
have to do
fun you can have at 1 o'clock on the
just
East
hit
Coast.
the friggin' button. It doesn't cost you anything.
Yeah.
You're not going to get inundated with emails.
All right. So, we're doing the Q&A section. I know we're getting out of here in 1 second. So just, answer me this. Why, Liz, is the S&P down 1.25% right now? And why is the NASDAQ down nearly 2%? Is it only the move in yields? And then I guess, why wasn't it down a lot yesterday?
There was a weak auction as we started the show.
I talked about auctions a lot.
I don't know if that's really the cause. We're about to get the beige book in 11 minutes. I do think that some of this is due to yields right now. I also think, and I don't know that this is what's happening today or what happened yesterday, but we sort of escaped election season without much volatility. So now here we are, we're up against it. It's coming in hot, right? Maybe we're finally having some volatility around the election. It still seems like a bit of a toss-up. We talked about this on Monday's show, that if the market is up into the election, it usually suggests that the incumbent party is going to stay in. But then if you look at the sector behavior in the market right now, you could say that that means that the Republican Party is going to take over. So I think there is just a lot of uncertainty around all of it.
Right now, Market Matrix is one of the most mature websites out there.
Well, we call it a podcast guy.
Podcast.
Website.
You know what? There's certain things that will never say.
Website.
Just a
is
lot.
one
No,
of them?
website I'll say, but you want to pod together. Like
Yeah.
that's a term you
Guy and
use.
I
As a
pod together
verb.
quite
You don't
frequently.
use it as a verb.
Well, what do you want to say? Record together? That
Would
could
you
mean
like
any...
to do a podcast with us?
Okay. Do
That's a
you
long
say
sentence.
Googling things?
Yeah.
Do you say Ubering somewhere?
I didn't know. I won't say Ubered there.
You
I'd
probably
say
have.
I got a car there.
Okay.
You would say,
so,
I took a ride share.
No, I would never say a ride
so
share.
every day after the close, about 4:30, Market Matrix drops. Guy and myself pod with Brunson. Okay. Brunson is he's like our little digital
way,
avatar. He's out there in the world in the site.
Knicks
He's
got their ass kicked
oh
last
my
night.
God, by the Celtics. You know, the Celtics, it was like they
Yeah, they'll get
they
their
put
rings.
the banner down,
Yeah,
they
I
got the
What does that have
rings.
to do with Brunson?
Jalen Brunson.
Jalen Brunson
Oh,
plays
okay.
for the Knicks.
Yeah, I don't
Yeah.
really follow
Yeah, he
the
doesn't play
NBA.
for the Bucks. That's
Except
So
for
here's what
Giannis
Market Matrix
Antetokounmpo.
is.
Yeah.
If you're
yeah.
following us here, we'd like you to go to your podcast store and follow it there. It's MRKT Matrix. Our team, we curate about 10 of the most important stories of the day in the markets, the economy, maybe a couple other things here and there. We have them summarized in an LLM. That would be what, Guy?
large language model.
Then we take the text and we put it into a voice model. That is our main man Brunson, who lives out there in the ether.
Okay.
And then you get a 10-minute podcast. Amanda ties it all together. It's a great kind of way to recap the day in the markets on your way home, while you're walking your dog. Maybe you're at the gym, whatever it is that you do, Liz, after the market closes. You can listen to that in under 10. Hey, listen, if you listen to it at 2x,
You get it at 5 minutes.
There you
If
go.
you
Look at that
listen to it
math.
at 1.5, it's 7.5 minutes.
yes,
I can do this shit
listen,
all
I
day
listen
long.
at 1.5. What speed do you listen to your podcast?
1.5
Yeah.
usually.
Yeah, it's amazing though
When
how
I listen-
slow
when I
people
listen
talk
to-
on these things
Yeah.
generally. You know,
I talk very quickly.
No, I know, but people say to us all the time on Fast Money, "Why do you guys talk so fast?" Because that's the way people talk on the trading
Oh.
desk. You're like bang, bang, bang.
Hmm.
All right, should we do it? Should we get out of here?
Yankees play Friday
Uh-huh.
in Chavez Ravine.
Uh-huh.
Game one.
Apparently, tickets at the Yankee Stadium, the cheapest
out of
tickets like
control.
$1,000
They're
just to
out
get
of
in the
control.
building.
Like
Out
the
of control.
nosebleed.
Just get in the friggin' building.
Yeah.
It's crazy.
Something's happened
You know where
over
it's
the last
free?
on your
couch.
television set. Damn
COVID.
straight.
COVID broke live events. I mean, and the thing.
What does that mean?
We didn't have them for a year and a half,
Uh-huh.
and then when it came
Oh,
back,
everybody's
ticket
rushing.
prices have just gone berserk. A lot of artists, in the music space, who were used to be really cool to their fans about pricing and stuff like that, they basically ceded it to, let's say, Ticketmaster, let them do dynamic pricing or whatever,
Now you're
and
getting-
they're getting a lot of money.
say it. You're about to say you're getting bent over. You're about to say
I
that.
was not going to say that, guy.
By the way, somebody said that. Yeah, you were.
That was, you know what
So-
that is? To be very clear to all of our listeners who might not have, got that visual, in the 1979 movie Animal House, there's a scene when they're hazing some of the pledges, and Kevin Bacon is bent over and they're hitting him with a paddle.
Yeah.
And that's where that comes from.
Hazing.
Thank you, sir. Might have another.
Yeah,
That
but you
is
shouldn't do that. It's not.
No,
cool.
it's bad.
That's why
No.
I would not have lasted at I went
You
to
were
a
gonna say
university.
sorority?
No, fraternity.
Okay.
But I was to say,
Just checking.
I would not have lasted because
No. You would not.
I don't need these assholes
No.
with the card
Paddles.
games telling me what to do.
None-
It's like,
none
go
of
fuck
it.
yourself.
See what he did there?
No, I'm
All
just
right,
not.
Let's
I'm just,
on
by the
that
way,
note.
that somebody just said that's not a playlist. It's just all the songs you've
That's
liked
what
on
I
Spotify.
say.
It's
I
bullshit.
say that all the time.
No, it's not. It's not. It's not true. It's factually not true. It's songs that I went out and found and put on a playlist.
But it shows up.
Guy's first
but
playlist.
but the logo is a heart and it says liked songs.
No, negative Ghost Rider.
So how many songs are on your liked
800
songs?
Huh? I have
How many-
890 songs. I got to like them too. If I have them, it's obvious that I like them. You tell me within the songs that I already like, I got to give an additional like.
No, you don't have to.
You follow what I'm saying?
Yeah, I guess.
No,
So
all right.
you-
You just
yeah,
want to get out of here.
But you added an extra step. You created another play. You could just like it and it would put it on a playlist for you.
I don't
called
want
liked
them to
songs.
make a playlist for because there's something that they do at the end. They say if you like these songs, it's like the artificial intelligence.
No, that's only if you click the little
By
shuffle button
definition,
that has
I
a
don't.
star
I
on
don't
it.
want their songs.
Okay.
I know the effing
Sometimes
songs
they're
I
good.
want.
Sometimes they're good.
By the way,
suggestions.
it's about to come out, Dan. Like the end of the year Spotify thing that you get in the mail.
Yeah.
They
Your
call
mom
it
would
wrapped.
listen to.
They call
By
it
the way,
wrapped.
Wrapped.
Uh-huh.
I have the last 2 years, which I think that's how long I've been doing this. I am in the top 1% of Led Zeppelin fans in the world. That's something else.
On Spotify.
Huh?
On Spotify.
In the world.
Yeah.
On
Okay.
Spotify.
Right.
According to Spotify.
Right.
That's pretty impressive. So
That
if
is
John Paul
impressive.
Jones is listening, or if Robert Plant or Jimmy Page are
Well, they
listening,
were number 3 and 4. If I
obviously
remember,
John
my
Bonham.
own statement
But
properly.
Bonham might be listening, although he passed away some 43 years ago, I think now. No, it's not even funny. To this day, it's upsetting. By the way, we just got through October 20th. Do you know what October 20th, 1977 was?
No.
So October 17th, maybe Elizabeth, I'm sorry. Amanda, can you do this for me, please? Just indulge me for a second. On October 17th, 1977, Leonard Skinner released Street Survivors, studio LP, Steve Gaines' first studio LP. The original cover of the album was the band engulfed in flames. And Amanda, if you can find this and put it up, you'll see what I'm talking about. October 17th, 1977. Songs like You Got That Right, That Smell, What's Your Name, I Ain't the One. Yes, you with me?
Sure. Yeah.
Okay. 3 days later, on October 20th, 1977, the plane carrying the members of Leonard Skinner crashed in Gillsburg, Mississippi, killing Ronnie Van Zant, Steve Gaines, his sister Casey Gaines. Look at that. That's the original album cover. Now, obviously, if you look closely at that, you'll see Steve Gaines in the middle with the red shirt, engulfed in flames. He died. Ronnie Van Zant, engulfed in flames. He died. Notice some of the other guys. That's Alan Collins on the far left. That's Gary Rossington, as the aforementioned Ronnie Van Zant, Steve Gaines. That's Leon Wilkeson with the hat. He's the bass player. That's Artemis Pyle in the blue shirt. He's the drummer. And on the far right in the white jacket is Billy Powell. Billy Powell was a roadie for Leonard Skinner. One day, Ronnie Van Zant heard him playing the piano and said, "Are you kidding me?" He became the piano player of Leonard Skinner.
Cool.
Now, they had to pull this album off the shelves and replace it with this album cover, if Amanda has that.
Oh, shoot.
After October 20th.
This album cover.
Watch. Amanda's looking
this
for
album
it.
cover.
So they went from Engulfed in Flames, October 17th, 1977, plane crashing October 20th, 1977, in Gillsburg, Mississippi.
Okay.
And then they went to this album cover. Amanda's leaving me hanging.
This album cover.
Come on, Amanda.
You know, it's interesting. If you
She's
guys
gonna find it. Look, see?
There you go.
All black.
So if you guys
But
have
still,
ever,
everybody's there.
one of my
What's the
favorite
picture?
movies, top 5 for me is Almost Famous. It came out, I want to say about 20. It came out in the year 2000 to 2001. And there's a scene there, and it's semi-autobiographical of Cameron Crowe, who wrote the book. He toured with the Allman Brothers as a journalist when he was a teenager in the 70s. But there's a scene towards the end where they're in a plane, the band that he's traveling with, and it almost crashes. And then he writes it up for Rolling Stone. And you know what he says? We're flying high over Tupelo, Mississippi, and we're all about to die. Like that's the so was it you remember that line, guy?
I do.
It's a great
and it
movie.
just goes to show you, if you're going down on a plane, okay, don't
dark stuff here.
Be suck it up. Don't be, you know what I mean?
As opposed to,
because what happened was in the movie, they think they're going to crash, and people start crying, and then they don't crash. And in situations like that, you learn who the tough guy is, and you learn who, is not.
Okay.
So if you're going down, similar thing, I'll save this for another market call. A similar thing happened to me, but I'll save it for another time. In a plane.
Really?
And I sat
how
there.
do I not know this?
You sat there how you normally sit there.
Yeah, of course.
Staring
because
straight
if you're
ahead
going down,
without
you're
the
going
television
down.
on.
Did you have fun?
I did.
You learned a lot about Leonard Skinner.
I did learn a lot about Leonard Skinner.
I mean, I did that.
And Led Zeppelin.
Yeah. All right, look, that's it. Tomorrow's Thursday tomorrow, right?
Yeah.
So it's probably just me and you tomorrow.
Maybe Carter.
We'll
check in on Carter.
We'll check in on Carter Worth.
Yeah.
I want to thank Elizabeth. When are you on CNBC this week?
Tomorrow.
The HTR?
Check it out.
HTR.
Elizabeth will be on noon tomorrow in the halftime report, dominating that squad.
Domination.
I mean, we'll share it. One of 3.
Yankees play Friday.
Guys, just extend this for 30 seconds. This is going to get us to 2:00. This is going to be one of the longest market calls we've had.
Well, then let's
because we're
on
that
save
All right. So you're talking about the October dates. What happened on October 19th, 1987?
October 9th, I was there. It was a Monday. It was the crash.
I was there.
I was sitting on the trading
Another
desk
type
of
of
Drexel Burnham Lambert. And the market back then, the Dow was like 1,700 points or something. So it lost like 400 and something. I mean, my numbers are probably off a little bit, But if you remember back then, this is 1987. The world, you didn't have Twitter and see all this stuff, so you're sort of getting it secondhand. But I remember grown men, mostly men. There were some guys like in tears.
Yeah.
Crazy.
You know what's interesting though? Like recent market participants, let's say you came into the market over the last, call it 10 years. I bet they have no no knowledge of 1987, because if you think about it, it was so short-lived.
Well,
you know what I mean?
Anymore,
No, well,
right?
I mean, listen, my
Circuit
only point
breakers.
is my only point is that we've had plenty of instances since then where the market had basically felt like a crash. It just
May
didn't
10th,
it just
2000 and what was it? What
May
day?
10th,
2010.
2010.
Was that right?
Yeah.
I'm trying to think. By the way, Amanda said, "Man, I don't know if you mean this or not, but if you can, I don't know if you do a screenshot of my Spotify playlist."
Oh, Jesus. Jeez.
No.
I get what the writer was talking about.
All right, it's been an hour.
Yeah.
And by the
Who's the
way,
writer?
so small
The
fries
person who-
$1.89, cheeseburger $2.39.
All right.
Okay, so that adds up. If you think about a drink, it gets you to the $5 value meal. That's all I'm saying.
Yeah. Well, but the point is, that's like way smaller of a meal without a drink.
Understood,
right?
because
And
you get a
it's still
double
more.
cheeseburger. The only thing I'm going to say this, and it's very, very sad. And Guy, you and I mentioned that on Fast Money. It was all breaking last night. It was very sad that someone died from this. It's very sad that dozens of people are sick from it. I haven't had McDonald's, I want to say, in I don't know, maybe 9 months, maybe a year. I'm really would like McDonald's right now. All this talk about McDonald's.
Well, it was the
I'm
onions.
just
It was
saying.
the onions on the quarter pounder.
But it's the sliver onions, not the diced
chopped,
onions.
right.
The
That's
diced ones, the
I like
chopped
the
ones
diced
are on
ones.
your cheeseburger.
Yes, exactly.
Yeah.
The more you know.
Well, hopefully everyone gets through this thing.
Would you
No
get a
more
breakfast
illnesses.
sandwich?
I don't know.
Egg McMuffins are badass.
They are.
I'm more of a biscuit
High
guy. I
protein.
like the
Canadian
egg and cheese
bacon.
biscuit.
Oh,
You know what I
yeah.
do? I take the egg off. I think it's so disgusting. It ships. That egg is not made in those McDonald's. Not saying that I want
They're
it
real
to.
eggs.
They're real eggs, but they're like,
Takes the egg off.
yeah. I just like the biscuit,
Why
the
don't you
cheese,
just-
and the bacon.
Interesting. Okay.
That's so odd.
That's
All right.
strange.
On that note,
All right, listen.
let's get
We'll
out of
see
here.
you later,
Thanks,
people.
everyone.
Thanks.
Bye-bye. Bye.